Let's break down what a stock really is. It's a fundamental concept in the world of finance, and understanding it is crucial for anyone looking to invest or simply grasp how businesses operate. We'll explore the ins and outs of stock ownership, what it means to be a shareholder, and how the stock market functions as a whole. A stock is simply a small piece of ownership in a company. Think of it as a tiny slice of a much larger pie. When a company decides to offer stock, it's essentially dividing itself into numerous small parts, each of which can be bought and sold by investors. When you buy a stock, you become a part owner of that business, a shareholder with a vested interest in its success. You're not just a customer, you're now an owner, albeit a small one, with certain rights and privileges. This ownership extends to its assets, profits, and future. As a part owner, you have a claim on a portion of everything the company owns, from its buildings and equipment to its intellectual property and cash reserves. You also share in the company's financial performance, both good and bad. Companies sell stocks to raise money for growth, providing them with the capital they need to expand their operations and pursue new opportunities. This is often referred to as an initial public offering, or IPO, when a company first offers its shares to the public. This growth could be anything like launching new products, entering new markets, or expanding operations. The money raised from selling stock allows companies to invest in these initiatives without taking on debt or relying solely on their existing profits. In exchange for your money, you get a share of their future success. Your investment helps fuel the company's growth, and in return, you stand to benefit from its increased profitability and value. If the company does well, your stock can increase in value, reflecting the market's perception of the company's prospects. This increase in value is a key reason why people invest in stocks. This increase in value is called capital appreciation. It's the difference between the price you paid for the stock and the price you can sell it for later. Some companies also pay out part of their profits to shareholders as dividends. These are regular cash payments, typically made quarterly, that represent a portion of the company's earnings. Not all companies pay dividends. It depends on their financial strategy and stage of growth. Many reinvest profits to grow faster, believing that reinvesting in the business will ultimately lead to greater returns for shareholders in the long run. This is common for younger, rapidly growing companies. Think of it like owning a piece of a successful coffee stand with friends, a small local business where everyone is invested in its success. Everyone chips in, and everyone shares the rewards. If the coffee stand thrives, everyone benefits from the increased profits and the growing value of the business. The stock market is just this idea on a massive scale, connecting countless companies with millions of investors around the world. It's a dynamic marketplace connecting companies needing money with people who want to invest and grow their wealth. This exchange of capital fuels innovation and economic growth. As a shareholder, you benefit when the company grows and profits, sharing in its overall success. If more people want to own a piece, driven by positive news or strong performance, your stock's value can rise, reflecting increased demand. But remember, you don't control the company. The management team and board of directors make the key decisions. You're one of many owners, and your influence is typically proportional to the number of shares you own. Stocks are traded on exchanges like the New York Stock Exchange, NYSE, or the Nasdaq, making it easy to buy or sell your ownership through a broker or online trading platform. The value of your stock can go up or down, sometimes significantly, based on how the company performs, industry trends, and what investors expect for its future prospects. In short, buying a stock means betting on a company's future, believing in its potential for growth and success. It's about becoming a partner, in a small way, and sharing in its journey, both the ups and downs. That's the core of investing in stocks, owning a piece of a company and participating in its potential success. Now let's see why this matters for you and how you can use this knowledge to make informed investment decisions. So, why should you care about investing right now? In today's world, with so much financial uncertainty, it might seem daunting, even risky. But the truth is, investing is more crucial than ever, especially for young people just starting out. It's about securing your future, building wealth, and achieving financial independence. The answer? Compound interest. It's the engine that drives long-term wealth creation. It's your money making more money, and then that money making even more. Think of it as a snowball rolling down a hill, gathering more snow and growing larger with each turn. The initial investment earns a return, and then that return itself starts earning returns. This exponential growth is the key to building substantial wealth over time. The earlier you start, the more time your investments have to grow. Time is your greatest ally in the world of investing. The longer your money has to compound, the more significant the results will be. For example, investing $1,000 at a 10% annual return, which is a reasonable expectation for diversified stock market investments, can snowball into a huge sum over decades. Over 30 or 40 years, that initial $1,000 could potentially grow to tens of thousands of dollars or even more thanks to the power of compounding. Time is your biggest advantage. Start early and you'll see the magic of compounding unfold before your eyes. Don't underestimate the power of starting small and letting time work its wonders. Investing also helps you beat inflation, which is a silent wealth killer, which slowly erodes your money's value. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. If you just save cash in a standard savings account, rising prices will make your money worth less over time. The interest you earn on a typical savings account is often lower than the inflation rate, meaning your savings are actually losing purchasing power. Stocks give your money a chance to grow faster than inflation, providing a hedge against the rising cost of living, protecting and increasing your wealth, ensuring that your savings maintain their value and grow over the long term. Investing isn't about getting rich overnight. It's not a get-rich-quick scheme. It's about building freedom. It's a long-term strategy for achieving your financial goals. Every dollar you invest is a step toward financial independence, bringing you closer to a future where you have more control over your time and resources. It gives you options to quit a job you dislike and pursue work that is more fulfilling, travel and experience different cultures, start a business and bring your ideas to life, or retire comfortably and enjoy your golden years without financial worries. The sooner you start, the more choices you'll have later. Investing early opens doors to opportunities you might not have otherwise. Even small amounts invested now, consistently over time, can make a huge difference in your future. Don't underestimate the power of small regular investments. Don't wait for the perfect time. Start with what you have. The best time to start investing is always now. Investing is about building a life with less financial stress and more opportunity. It's about creating a foundation for a secure and fulfilling future. Your future self will thank you for starting today. You'll be grateful you took the initiative to invest in your future. Let's move on to how you actually get started. We'll break down the process into simple, manageable steps. First up, choosing your broker. This is a crucial first step in your investment journey. Ready to invest and take control of your financial future? That's fantastic. Investing can be a powerful tool for building wealth and achieving your long-term financial goals. First, before you can buy stocks, bonds, or any other investments, you need a broker, a company that acts as an intermediary, connecting you directly to the stock market and facilitating your trades. They're your gateway to the world of investing. Today, thankfully, most brokers are easy-to-use apps or websites designed with the everyday investor in mind. They offer intuitive interfaces and a wealth of information at your fingertips. Gone are the days of needing to call up people in suits. The power to invest is now in your hands. When choosing a broker, look for zero-commission brokers like Fidelity, a well-established and respected name in the industry. Schwab, another excellent choice with a long history of serving investors. Or Robinhood, a popular option known for its user-friendly mobile platform. With so many zero-commission options available, there's really no reason to pay fees on basic trades anymore. Keep that extra money working for you. Choose a platform that feels intuitive and easy to navigate. You want to feel comfortable using it so you can focus on your investments, not on figuring out the app, and offers good educational resources. Look for brokers that provide articles, videos, and tutorials to help you learn about investing. Don't be afraid to test a few apps. Download a few different apps and play around with them to see which one you like best and which one fits your needs. Make sure your broker is reputable and has a solid track record. Look for reviews and ratings from trusted sources, and insured by the SIPC, the Securities Investor Protection Corporation. This is crucial, as it protects your investments if the company fails, providing a safety net for your assets. Also, check that they offer the types of accounts and investments you might want in the future. Think about your long-term goals and make sure the broker can accommodate them. Like index funds, which are a great way to diversify your portfolio. or retirement accounts, such as 401(k)s or IRAs, to help you save for your future. Picking the right broker is the foundation, the very first step of your investing journey. It sets the stage for your success. So take a little time to compare your options and do your research. Once you've chosen the broker that's right for you, you're ready for the next step, opening your account and getting ready to invest. Let's walk through that process together, step by step. It's easier than you think and will guide you through every step of the way. Opening an investment account is quick and simple, usually just a few minutes online. You'll provide basic info like your name, address, and social security number for legal reasons. You'll answer a few questions about your finances and goals. Just be honest. Once approved, you'll fund your account usually by linking your bank and transferring money electronically. Thanks to fractional shares, you can start with as little as $5 or $10. Don't stress about starting small, the key is to begin. Your money may take a couple of days to clear, but once it does, you're ready to invest. The process is designed to be user-friendly even for beginners. Just follow the prompts and you'll be set up in no time. Now, let's talk about how to manage risk and build a smart portfolio. That's where diversification comes in. Here's what you need to know. Investing always involves risk, the chance you could lose money. Higher potential rewards usually mean higher risk. Stocks can rise or fall, sometimes sharply, but offer greater long-term growth than safer investments like bonds. Never invest money you'll need soon. The best way to manage risk is diversification, spreading your money across many companies and industries. Don't put all your eggs in one basket. If one company fails, others can make up for it. You can diversify by owning different types of companies, sizes, and even countries. The easiest way for beginners? Index funds or ETFs, which bundle hundreds of stocks into one investment. For example, an S&P 500 index fund gives you a slice of America's biggest companies in a single purchase. Diversification is your main defense against risk. It helps smooth out the ups and downs of the market. Next, let's talk about how to pick what to invest in. So what should you actually buy? Start with what you know, brands and products you use and trust. Make a list of companies you believe in, then do some basic research. Check if their sales and profits are growing and if they have a strong advantage over competitors. Look up their financials and recent news. Are they innovating or facing problems? You don't need to be an expert, but a little homework goes a long way. Focus on companies with a track record of success and a clear edge, or for instant diversification, consider a broad index fund. You ready to invest? Log into your broker, search for the stock or fund you want, and hit buy. For your first purchase, use a market order. It buys at the current price, fast and simple. Thanks to fractional shares, you can invest any dollar amount, not just whole shares. Review your order, confirm the details, and place it. That's it. You're now a shareholder. You'll get a notification when your order is complete. Congratulations. You've taken your first real step as an investor. Remember, it's about building wealth over time, not overnight. Now let's cover some common mistakes to avoid. Staying smart is just as important as getting started. New investors often let emotions drive their decisions. Panic selling when prices drop or buying in a frenzy when stocks soar. Don't try to time the market. Even experts can't do it consistently. Invest regularly and stick to your plan, no matter what the headlines say. Avoid checking your portfolio constantly. It leads to stress and bad decisions. Don't chase hot tips or gamble on risky stocks you don't understand. Do your own research and focus on quality companies or diversified funds. Building wealth is slow and steady, not flashy or fast. Turn off notifications and check your investments just once in a while. Stay disciplined, avoid hype, and keep your eyes on the long-term goal. That's how you win at investing. Investing isn't about getting rich overnight. It's about building wealth slowly and steadily. Stories of instant millionaires are rare and risky. Most real success comes from patience. The market will have ups and downs, including crashes and corrections. Don't panic during downturns, see them as opportunities to buy at a discount. The key is to keep investing regularly, no matter what the market is doing. This approach, called dollar cost averaging, takes emotion out of the equation. Set up automatic investments and let time and compounding work for you. Patience and consistency are your greatest tools. Remember, you're planting a tree, not buying a lottery ticket. Stick with it, and your future self will thank you. Here's what matters. A stock is a piece of a company, and investing is your path to long-term wealth. Technology makes it easy to start with just a few dollars and a few taps. Choose a reputable broker, open and fund your account, and make your first investment, ideally in a diversified fund or a company you know. Avoid emotional mistakes, ignore get-rich-quick hype, and focus on the long game. Keep learning, but don't let research stop you from starting. The best time to invest was yesterday. The second best is today. Even small amounts make a difference over time. Every dollar you invest is a step toward freedom and security. Take that first step now. Your journey to financial independence starts today. The future is yours to build.